We have never seen such a proactive response to markets before a crisis happens. As you get into fall, particularly near the election or post-election, you have to be incredibly cautious. Trying to pick the top in what is a dramatic bubble driven by liquidity is a very dangerous thing to do. But I would be very surprised and actually mildly concerned of why a deal gets done on the long term of what's happening in the Strait of Hormuz.
What's happening in the markets is truly unprecedented. What is driving this historic rally? Who is causing this rally? And what's about to come next? Why is the S&P 500 still at an all-time high despite the ongoing war with Iran? Our next guest, Cem Karsan, CIO and founder of Kai Volatility Advisors and Kai Wealth, will have the answers. And this is one of the most fascinating interviews I've done in a while. His answers truly shocked me. I'm on the road right now. As you can see, my background's different. And I've had a chance to speak with a few interesting people all week, and Cem is certainly one of them. This video was brought to you by Kalshi. It's a prediction market and the largest prediction market in the United States. Unlike a sports book, you're trading peer-to-peer on real-world events, from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below and use my code LIN, L-I-N, or scan the QR code here. New users will get $10 when they trade $10. For example, you could put $50 down on what the Trump administration is going to announce for a deal with China, a potential deal with China this week as Trump meets with Xi Jinping in Beijing as we speak. This actually is one of the topics of our conversation today. You could potentially make up to $62 in return if that is correct. Well, we'll find out what the answer is and what Cem thinks is about to happen. This is a very exciting episode. And as always, please do subscribe if you haven't already. Cem, welcome to the show. Good to see you.
Great to be here. Thanks for having me, David.
Let's pull up a chart of the S&P 500 and we can walk through this together. This has been one of the most significant rallies in recent market history. Since the bottom, the recent trough in late March, the S&P has rallied 16.5%, almost 17%, depending on the time of the day, in a span of a month and a half, 6 weeks. This has been on the back of a rebound following a less than 10% correction. Can you just explain to the layman investor out there the significance of this type of rally and how common or rare it could be?
Yeah, so we have in the last almost 100 years had only 9 rallies of greater than 17% from bottom to top in a 1-month period. So already quite rare. But what is exceedingly rare, and a data set of 1 in a century of market data, is a rally of this size and speed that has come out of a decline as shallow as the decline we've had. The other 8 instances of this type of speed and size of rally have all come from a 20% decline or greater. So this decline was 9%.
Okay.
Why? Why have the other 8 rallies of the size and speed all come out of a big decline? Well, obviously, if you have a 20% decline or more, that is something meaningfully bad is happening in the world, or some crisis or fear exists. And in those situations, what would you expect? You would expect positioning to get short, hedges to be entering the market, some type of stress. And that stress creates a short interest and a under leverage into the market that can an underinvestment in the market that, when responded to said crisis or concerns, is in response to that, you have a generally government, a Federal Reserve, Treasury, governmental response, which then offsets that risk and creates a turn and squeeze in markets. A size and speed of move of this.
Sorry, please continue.
Go ahead. No, I was just going to say, so obviously that response is happening. That liquidity that's coming in is an attempt to turn the tides on said crisis. So this is different. in the sense that we never had the crisis happen in terms of market action, right? But if you look at the data, the short interest and the positioning in preparation for what people were seeing already, the facts on the ground of a crisis, was actually there. And the other part, which has happened in all these other scenarios, also happened, which is a orchestrated response of both liquidity and other things, which we can get into, from the government to help respond to what they saw as the crisis that is coming. It is the difference between the other 8 times is this is proactive. Proactive. We have never seen such a proactive response to markets before a crisis happens. And that is really what defines this data set and why this is happening at this time.
So can you just elaborate on what this crisis is? Are you referring to
the biggest oil shock that's ever happened? Yes, that is a crisis.
Hasn't that already happened, Cem?
No,
not yet.
It is something that is happening. If you look at what happened in 1973 in the OPEC crisis, markets actually went sideways, slightly up, slightly down for many, many months before the real crisis actually hit. And this, by most sources, you can tell me your thoughts, David, but is a bigger oil shock than in 1973. And in terms of the supply shock itself. I'm talking about the price of oil, but the supply shock. Okay. So the big difference here is a really focused intention to create some type of market buffer and liquidity buffer to help manage what's coming ahead. We can go through all of the other things that the administration has done, historic responses and preparations across many, many different categories, which we can get into in the last 6 weeks. But the critical part to understand is if you look at that data, it speaks volumes and it makes sense. All of them fit the same criterion, which is short interest and size of positioning getting really bad, and a response from government to squeeze the market, push it higher, respond to the crisis, however you want to say. But all those were reactive. This was proactive. And,
response by the government. Can you just explain to us how the government is exactly responding to this crisis by injecting liquidity and the mechanism with which they're injecting the liquidity?
Yeah, several different paths. So it's not just shooting money in liquidity. The biggest part, which is reflexive, is managing the market itself. I want to highlight 300. Most people don't understand. People think of markets as a ticker that is an output to what's happening in the world. If you listen to CNBC, you listen to most sources, markets are, the market went up today because, right? It is a response or an output. I want people to fully appreciate and understand that more important nowadays, given the size and scale and leverage of financial markets and how critically they touch everything in America in particular, not all over the world, how critical they are to outcomes themselves. You have a $300 trillion, I want to repeat, $300 trillion of assets in both equity markets, about 150 trillion in public equity markets, private equity, private businesses, everything that is tied to the valuations of public markets, $300 trillion. When you rally the market almost 20%, that is a $60 trillion of new collateral that you've created. And a system itself that's incredibly leveraged and tied to leverage. Majority of money is leverage, not actual dollars. So, and again, to put that in context, $60 trillion of new collateral in the world is an order of magnitude more than all the liquidity that was pumped into the system through the Federal Reserve and fiscal spending during COVID. Now, obviously there, you also had a market that rallied tremendously, right? Which is also the point which reflexively leads to the liquidity being pumped in. But the Federal Reserve and the Treasury's primary role now is to manage markets. They could pump in $20 trillion, but if the market doesn't go up in response to it, if the market goes down 5-10%, that offsets the liquidity that's coming into the market itself.
Wait a minute. How is that part of how does that even relate to the mandate? Why does the Federal Reserve, and to a certain extent, the White House, why do they care how financial markets behave?
Yes. Several reasons. One, CapEx cycles, growth of the economy is tied to liquidity. I'll give you a great example. 1999. Guess what guess what earnings growth was in 1999? 30%. Earnings growth was 30%. Dramatically exceeded expectations of 15 to 20%. We had a massive CapEx boom happening in 99. Why did the CapEx boom happen in 99? Everybody attributes this growth to some magical, oh, that's just what growth is. The economy's growing because good things are happening. And so the market reflects it. But the key part that people don't believe.
As to what that is this year. Let me take a guess because I don't know the number and this is fun for me. Let me just take a guess. So it was 30% in 99.
Is earnings growth, yeah.
Earnings growth.
The S&P 500.
It is near 100% now?
No, CapEx, earnings growth just last quarter annualized at 27. But way up from the expected, again, 15 to 20%. So point is, the earnings growth that you see tied and the revenue growth tied to the CapEx structure is a function of valuations and equity markets going up. When you take an Anthropic that goes from a $350 billion private market valuation to a $1.4 trillion valuation in 3 to 6 months, that new money goes somewhere. Where does it go? Goes to CapEx build out, goes to building and creating the product that doesn't exist yet, which then drives new revenue, which for certain entities, new growth, new capital being pushed in the system. So that's just an example with Anthropic, but it's across the whole thing. Now, what do you think happened to earnings growth in 2000 after the market declined?
I'm going to say negative 20%.
Imploded. 95% of internet startups went bankrupt in 95.
Yeah.
I ask you, was that because the economy just slowed, all of a sudden went from massive breakneck speed to just decrease? Or was the market's allocation of liquidity the primary driver? We know this. This is in 2000. And the point here is that very few people look at it this way and understand, look at the world through this vantage point. That said, the Treasury Secretary and the Federal Reserve, you better believe, understand these dynamics. This is critical to the way markets there's a naive view in the world that markets themselves are not being somehow managed or that they themselves are not the target. Because of course, no administration wants the world to think that is our goal. But when you have 50% of all consumption, by the way, outside of the corporate part I talked about, where you have this investment, right, just from a corporate level, which then you can put to work and invest into your business and then grow the business. That's a kind of a B2B reality. From a consumer perspective now, 50% of all consumption comes from the top 10% of the wealth distribution. So what happens if the market drops 20% or rallies 20%? Well, those people are 20% wealthier. And we call it the wealth effect, but the wealth effect has never been bigger than it has from just an economic revenue perspective. So there's two different parts, but the bigger part is the just pure amount of liquidity pushed into corporations and the amount of capital investment and the flywheel that drives. Now, that is not the only thing that matters. I'm not saying it's the only thing that matters. I'm just saying the growth and importance of it, it's always mattered, but the growth and importance of it has become dominant in the system. And this is why we have a hedge fund manager as Treasury Secretary. It's why we have a hedge fund manager now starting as head of the Federal Reserve.
I understand your rationale. The wealth effect is going to impact all levels of the economy, is your thesis. And so if the stock market collapses, then the Federal Reserve has to deal with higher unemployment, which is one of their mandates. However, Trump literally just said to a reporter when asked the motivation behind making a deal with Iran, does he look at the financial position of American citizens? And he said, and I quote, "Not even a little bit. The only thing that matters when I'm talking about Iran, they can't have a nuclear weapon. I don't think about Americans' financial situation.
Yeah.
Your response.
I'm going to loosely quote a couple other Donald Trump quotes, and you tell me if we should be listening to all of Donald Trump quotes as fact. This we have a deal with Iran, and it'll be done in 2 weeks. That's from 8 weeks ago. We will bomb a civilization into oblivion tomorrow, followed by we have a deal, peace in our times. Trump's primary objective, and actually his primary tool, which is a great transition point in the administration's primary tool of managing markets, is actually not the core liquidity itself. It's not driving, trillions of dollars of liquidity into the market, and manipulating markets from a buying markets and front running. It is understanding market flows and releasing in a very coordinated way, which is well documented across 50 different aligned Twitter accounts and media's sources, an orchestrated set of messages to manage the market. The words he says, as any good poker player would do, right, is not an intent to tell the world what he's going to do, unless that achieves his outcome. It's to convince the market that they're better off listening and following that path. This is the Draghi, whatever it takes type comments. People in power have the ability, particularly if they have a high stack at the poker table and can bully people around, to push markets. But the key part here is that message or that bullying itself is not creating the liquidity. The market is. And the reflexive effects of markets is the key. It is the target. It is the goal. And so this is a very sophisticated administration. Bessent broke the pound. We're talking about somebody who understands markets and liquidity intimately well. And they have and by the way, it's not a coincidence that the V bottom we had was on March 31st, the end of the quarter. We can go through all the liquidities and the exact reversal and timing and coordination of the messages that went from end of a civilization, Great Depression tweets, followed by peace in our time. We'll be done in 2 weeks. Both of those things were nonsense, much like 150% tariffs last April, followed by 10% for some, 0% for others. We'll see. Things are good now. The V bottom that was orchestrated last April is now seen through the vantage point of what was happened now, which was much more clear and coordinated even than the first one, right? And now we have a pattern, is a very clear, sophisticated, thoughtful way of moving markets. The release of the tweets in the morning, right before the open, right before the close, the reversal of information, the getting markets on the off foot, and then pushing positive outcomes. It'll be done in 2 weeks. It'll be done in 2 weeks. We're almost there. It's done. It'll be done soon. Followed by, anytime the bad news comes out, have we had any reactions negatively in the market on the back of all the bad things that have happened in the Strait of Hormuz since? The market go down when they moved to expand their control. Iran expanded its control of the Strait of Hormuz and started to control the underwater wires that are cables that are controlling all internet and all data throughout the region. No, there's been zero response. Why? Because each day a message, much like the message you just read, by the way, are put out there so that markets and media sources say, just like you're saying, hey, look, that's not reality. Reality is blah. So you can't take the Donald Trump tweet and use that as some source of truth. That is actually the whole method of the madness. It is actually a sophisticated, thoughtful approach. If you put me in that same space, knowing what I know, I do the same thing.
Okay, let's talk about Trump's deal with China. This week, China actually, so Trump just landed in Beijing earlier today, accompanied by a host of American CEOs. He's set to meet with Xi Jinping. This is from Kalshi Prediction Market. What will Trump announce as part of his China trip? We have a series of events or deals, outcomes on the table here. Now, this is significant because talking about front-running news, traders would like to be positioned ahead of what may be a deal. So what do you think is the most likely outcome from this meeting? Just a few options ahead on my screen. U.S. soybean purchases, Boeing aircraft purchases, fentanyl precursor crackdown, rare earth export extension, just to name a few. Anything else on your radar?
Yeah, first of all, to follow on what I was saying, is it a coincidence, given everything I just said, that the CEO of NVIDIA is on the plane, that Elon Musk is on the plane? This is not an administration that is just going out there from a policy perspective negotiating. They're bringing along corporate interests on the plane for the negotiation. Why? What does that signal? That we are going to drive profits to American companies, particularly the sector here that is flying, and we're going to find some type of deal here that is going to provide profits to that center. Now, is that going to, in my opinion, resolve the larger crisis between the larger proxy war between China and the U.S.? That's what is happening in the Strait of Hormuz. This is not about nuclear, again, just because he says this is about nuclear weapons in Iran. This is not about nuclear weapons. This is about the Strait of Hormuz, has been from the very beginning. It's about the petrodollar. It's about the exorbitant privilege of the U.S. dollar and maintaining the grand leverage that the U.S. hopes to maintain in a larger global conflict. It's about who's going to control power of the world for the next 50, 100 years. The move in Iran, much like the move in Venezuela, it's not a coincidence they came back to back. Did Venezuela have nuclear weapons? Only Venezuela had nuclear weapons. Is it a coincidence that we went to Venezuela and then we went right into Iran? It's not. Is it a coincidence we're talking about Greenland? Does Greenland have nuclear weapons? So my big point here is I think this whole narrative that this is about nuclear weapons, or that Israel kind of cajoled and took the U.S. military and administration is incredibly naive. This is a larger, much bigger global leverage point and conflict in Iran. And so the reason I dive into that, to answer your question now, I apologize if I've digressed a bit, is to maintain that leverage. So I personally do not believe the Strait of Hormuz issue gets solved here. But I do believe that that there is some type of investment that comes from China into some of these, and coordinations on an economic front, not economic, I should say, from a financial corporate front, right? But I would be very surprised and actually mildly concerned of why a deal gets done on the long term of what's happening in the Strait of Hormuz. So
he is trying to solicit Chinese investment into U.S. manufacturers. And perhaps if this particular deal gets done, we could see a reduction in tariffs. What do you think? Will it get done?
I think a reduction in tariffs could very well happen. Tied to an actual investment, a capex investment from China. So I do think there can be a significant divergence between kind of tariff policy and some of the economic policies, and actually physically what's happening with oil and the Strait of Hormuz.
Okay, I want to comment on a few data points concerning options markets, of which you are an expert, before we close off the interview. So I have in front of me, I'll pull up the screen here, 0-day to expiry options, which for the audience are contracts that expires the same date the trading. Now, let me just take a look at what's on my screen here. So trade volume data, this is what's in front of me. And this is significant because we have here a situation in which 63% 0-day to expiry options hit a record of 63% of the SPX volume in March per the CPOE. Why is that significant?
I think the most significant thing is actually not that the zero DTE is becoming a greater percentage, although I'll address that. It's that options volumes writ large are exploding and have been exploding higher for 5 years, and exponentially so. Options are, and again, this is a little out of the box for most people, they are a dramatically better way to position in the market. It's like a better technology. It's like saying, hey, there's candlelight or there's electricity. Objectively, electricity is more efficient and is a better way to light your house. Like any technology, you need network effects, you need adoption, you need standardization, you need access in order for technologies to hit a tipping point and inflect higher. This has happened for options. Options have been growing structurally for a long time, but when I started the business 27 years ago, there were simply quarterly options at 1% width in just the S&P. I mean, imagine the infrastructure growth. Why is this a better technology? I want to be clear. When you buy an asset, any asset, stock, bond, commodity, you take on the full exposure of that asset. It goes down one, you lose one, go up one, you gain one. You are short a put, you're long a call at every expiration. When you choose to buy an out of the money call, you only take on those moments of the distribution, a very small part. And depending on the time that you choose, you only choose that part. They're much more precise. I can have two stocks that I put in front of you that are the same industry, same market cap, and you would think, oh, those, I don't put a name on them. You think, oh, those are the same stock. Peel back the option chain. One is right distributed, left tail. One's left distributed, right tail. One is a company, the pharmaceutical company that has a long-standing, very profitable drug that has the potential to be disrupted and lose all of its money. The other one has is an oncoming, likely not to succeed drug that will likely make the company go bankrupt eventually. But if it's right, it will take over the whole industry. Point is the data set underneath the market and the ability to bet on the different moments of this distribution, the realities of these are much more sophisticated, much more detailed. And so adoption has gone to the roof because it is a more precise, better way to express all. A stock or a bond or an asset, any kind, is just the expected value of that incredibly rich three-dimensional distribution. When people talk about options as derivatives, they miss the point. The options chain is actually the three-dimensional dog. It is the greater picture of the actual asset in all its forms. And the asset itself, price, is the derivative. It is the expected value of that whole distribution. And the way those stocks or assets move are a function of the moves in the much greater, much more detailed, data-rich options chain. Okay, so I say this to explain to people that this is not something that's just oddly growing as a corner of the market. It will eat the whole market, and it is in the process of eating the whole market. I've been saying this for 5-6 years. If you understand what options are and the power they have, the only problem was they didn't have enough volume and enough liquidity and enough infrastructure to absorb that for a long time. And we have now hit the network effects and the flywheel that will create more volume, more and hence from there. So now, having said that, why zero DTE? Zero DTE is simpler by definition. It is already hard to look at a distribution and say, I want this part of the distribution. When you bring in time, you create, you have implied volatility, and the move of implied volatility to understand and to manage. And that has been proven as in 2022 to be very difficult for hedgers. And so they've increasingly moved away from that because they just want to express their time, their bets in terms of realized bets. Implied volatility is hard to express. So the early volume and the success that people are having using options has been focused on the much easier first order effect of realized volatility, which is what's happening. There's very little implied at the 0 DTE. When you move to 1 month, 2 month, 3 month, a lot of the returns of options become tied to the actual implied volatility itself, which again, people have less knowledge or opinion on and don't want to bet on. And that is what's driven the dramatic increase in the flywheel of 0 DTE.
Two final questions before we close off. We only have a few minutes left. Cem, thank you very much. So putting all this together, direction of markets, what do you think is going to happen next? You have the management of markets, as you would put it, by the government, probably one of the largest and most significant rallies in recent history following a short decline, and your explanation on the significance of ZTE options. What is about to happen next? What are these signals telling you?
Yeah. So highest probability is an intent to continue to squeeze and support liquidity into what is a deteriorating broader structural picture. It is a pricing bubble. It is the only data sets on multiple levels that compared to now is exactly that date, 1999 to 2000, that I put in front of you. But the path on a bubble is incredibly unpredictable by definition. You can have a 20% rally before you get a decline. In early 99, if you knew that this was a bubble, which we did, I was trading at that time, and said, look, this is not going to end well, you could still, we still saw a dramatic rally. Even more detailed, I'll give you a couple quick data points. In October of 1999, the Dow Jones topped. The structural stocks and the pressures in the system were already very clear. The NASDAQ, and they declined together 10%. Actually, NASDAQ declined maybe 12 to 15%. But then what happened? Then the market rallied back. NASDAQ rallied 29% into March of 2000. And the Dow never topped again. The Dow itself saw its top in October, but the NASDAQ rallied almost 30%. Sound familiar? Does that sound familiar at all? We just declined 10% across the market, and we have an incredibly uneven rally where semiconductors are up 60% in 6 weeks while we sit at record valuation. So my answer to you is that's the data set.
Okay.
And it rhymes incredibly well. Now, and it also, timing-wise, lines up very well with the November midterm election, which drives incentives. So, as you get into fall, particularly near the election or post-election, you have to be incredibly cautious. What happens between now and then? Very well could see a little bit more of this, but trying to pick the top in what is a dramatic bubble driven by liquidity and an attempt to, kind of driver of liquidity into what is a massive bubble is a very dangerous thing to do at all.
I have a final
that
question.
said, lastly, very short, last 2 seconds, sorry, because I want to give everybody the crumbs. We're heading into the summer. Historic vol compression. This is what's different than 99 options. All these other things are different. The amount of vol compression this summer is likely to also help hold things at bay and allow the administration to continue to keep the plate spinning while the geopolitical realities of the oil costs, et cetera, are on a lag and are going to take some time to hit it as well. So you put those all together, you see a timing window of after the summer as more likely.
Excellent. Final question, 30 seconds before you go. We talked about the wealth effect. If the stock market collapses, the rich stop spending more money, and we understand what happens next to consumer spending overall. Does the opposite apply? If somebody were to explain to you, probably not even an investor, just somebody observing the markets were to ask you, Cem, if you look at my screen right now, the S&P 500 has grown almost 200% in the last 5 years. Why hasn't his wealth grown proportionally by 200% over the last 5 years? How would you explain that question? Why isn't his income double? Why isn't his, RSP double, right?
Yeah. Again, the amount of liquidity is not driving to people. It's driving to corporations. It's driving to the holders of corporations. When the market goes up, Elon Musk, 200%, Elon Musk's net worth quadruples, just like it has, right? Does everybody else become more wealthy? Inequality in the United States has exploded higher and is only accelerating as a result of all this. And so the average person is being left behind, and the economic growth or consumption is actually a small percentage relative to the actual CapEx growth, the corporate growth, the business to business growth. And that's the story.
Okay. Excellent. Thank you very much. Where can we follow you, Cem?
You can find me at kaiwealth.com or kaivolatility.com or on Twitter at jam_croissant. We do some of our own podcasts as well, which you can find us on YouTube under Kai Media.
Excellent. It was a pleasure to host you. Nice to meet you. Welcome to the show, and I hope to speak with you again. Thank you.
Thanks for having me, David.
Thank you for watching. Don't forget to follow Cem and Cem Karsan in the links down below, and we'll speak to you again soon.